Paul Pittman's biography, his CV, ticks all the boxes. A master's from Harvard in public policy, a JD from the University of Chicago, mergers and acquisitions experience with only the best of the best, Sullivan Cromwell and Wasserstein Perella. And of course, his tenure as head of the Emerging Markets M&A division for Merrill Lynch in London. Yet behind those credentials is an Illinois farm boy, a fighting Illini who got a degree in agriculture. Yes, he most definitely is the chairman, the president, and the CEO of the nation's largest farmland REIT, Farmland Partners, which is why what he's about to share with you about farmland values and the emerging markets in the next few years will prove to be so interesting. Paul Pittman, please join us. Thank you.
Thank you. Thank you, Eric, and thank you, Steve, for inviting me. What I'm going to do today is talk for maybe 15 minutes about farmland values, and then I'm going to open it up for questions. So just a couple of things I need to cover preliminarily. When you're the chief executive of a public company, you end up feeling like you don't go anywhere without a lawyer. And so I didn't bring the lawyer, but they had to send me a note. And so what that largely says is I'm going to make forward-looking statements today. Please don't sue me or our company, Farmland Partners, for the statements I make, even if I'm wrong. I don't think I am, though, and we'll get into that in just a second. So just a little bit, I won't really cover my background other than to say I was a direct farm operator for about 5 years. Farmed around 13,000 acres in Illinois and Nebraska. The truth is that's way harder than being a landlord, which is why I am now just a landlord. So this is our company a little bit. We own about 150,000 acres spread across the United States. It's in 16 different states. We have about 100 different tenants. Our primary model is to buy farmland and then rent it to farmers. We don't directly operate hardly any land at all. Sort of the mantra in our company is that if we need to teach the farmer how to farm, what we need is a different tenant. So we don't want to do a deep dive in terms of the management of individual assets. Our fundamental approach is to find good operators, good stewards of that land, and to let them do their job. We have annual revenue of around $50 million. And the only other plug I want to give for my company before I get into the meat of this, we trade today at around $9.25 a share. If you went to FPI as the ticker symbol, I believe that stock is worth $14 a share. I'm on the record having said that for quite some time. More importantly, I continue to buy stock under that assumption. The public markets really misunderstand agriculture. They fundamentally think that farmland is corn price. And as most of you in this room or watching this from home, farmland is not about the grain price. I tend to look at commodities, rents, and farmland in the following way. Commodities is about approximately a 6-month supply-demand picture of those fundamental commodities: corn, soybeans, wheat, rice, etc. Farmland rents are set on the ag profitability of that farmland in the next 3 to maybe 5 years. That's that when you're having that negotiation with a farmer, or you're a farmer having that negotiation with your landlord, that rent is being set based on that 3 to 5 year view of profitability. Land values are different. Land values are fundamentally set on the 50 years view of global food demand growth and all the other demand factors for land. I think one of the biggest misunderstandings about farmland, particularly in the United States, is that the absolute scarcity fact is missed. The scarcity of land is unlike any other real estate class. There is fundamentally no shortage of garden apartments. You can find another piece of land and build as many more apartments as you want to build. This is also true of office. This is true of virtually any other real estate asset class. But farmland has a floor of agriculture value and then all those higher and better use demands. And people then say to me, well, Paul, how can that be true? We're not going to have a subdivision in rural Colorado or rural Iowa, but if you take the land out of production on the edge of Des Moines, you raise the land value 50 miles away for food production because you've taken out land. So here goes on the key prediction. I believe that farmland today should be priced at least 2013 levels. So central Illinois, northern Iowa, think $12,000 an acre. And I think that is too low, given largely due to the fact of increased trendline yield since 2013. So the drivers here are increasing commodity prices, increasing trendline yield, increase operator productivity that Robert spoke about, reduction and stabilization of input costs, and low interest rates. The risks you can see on the right-hand side of the column, I think you have to continue to pay attention to them. They are very real. So let's turn to these key reasons for just a second. So grain prices have now gone back on a per bushel basis to essentially where they were in 2013. And land values haven't really gotten there yet, but I think they will. This all came about late in the fall, as we all know, in terms of the price change. So I think it takes a while to show up in the land market. But I think the real driver is really the next slide. We all remember the land value run-up between roughly 2005 to 2013. Maybe it started a little earlier. I believe the big driver of that was, number one, increased Chinese demand for soybeans. The secondary driver was ethanol. I think what you're seeing today is almost the same setup. You've got China demand starting aggressively for corn. This is a new fact. It didn't happen a few years ago. You see that in the red line on the bottom right, and the box at the top, if you can read it, says that Chinese corn inputs since 2013 have gone up 400%. To find a similar thing for soybeans, you'd go back to about 1994 to 1996, and just like that red line for corn, soybean imports into China had barely moved for decades. And then all of a sudden, the trajectory of that line turned up and it took off. I think that's happening now. I think the comparison to ethanol is now biodiesel. I think you're going to see substantially more biodiesel production, and that will be a little bit the new ethanol. It will be a secondary factor in my view. So let's look at trendline yield, and this is a straight line based basically on the USDA trendline yield, and then we project it out to 2021. What it really shows is that we're seeing a slightly over 1% increase in soybean yields, and that continues to move through time. And the next page really looks at corn yield, and again you're seeing about a 1.3% increase in corn yield. That steady increase in yield per acre really drives revenue per acre. We've all heard that expression where people say, and I go meet with some investor in New York City and they say to me, the real price of corn hasn't changed in, 50 years, sometimes somebody says to me. How can land values go up? It's a bubble. No, it's not. I'm 58 years old. When I was a kid, high quality land, central Illinois, you got 100 bushel to the acre, you were thrilled. I can remember first time we had 120 bushel to the acre. How many of you on the flat black prairie soils of Iowa or Illinois would frankly want to shoot yourself if you had 120 bushel yield? Okay? That yield per acre has skyrocketed. And that's only part of it. That is easy to convince people of. It's a little harder to convince people of what's happened in terms of factor level productivity improvements for farming. And Robert Sake went through this better and more entertaining way than I ever can. But this is incredibly powerful. The amount of grain measured per bushel, not per acre in terms of cost and inputs and efficiency, but measured per bushel, is collapsing almost as rapidly as the cost structure underneath things like consumer electronics and semiconductors. We as agriculture producers don't really get enough credit for that. But you think about how many people own a high-speed planter? How many people own a 24 or 48 row planter? And how many of you would say, even a decade ago, my planting pace, or even more importantly, my spraying pace, was at least 50% of the speed it is today. So we have seen massive increases in the productivity and therefore reducing the cost per acre of production of the primary commodities. And I list a variety of them here. The first is variable rate fertilization and seeding, but there's many others. I'm going to turn just to interest rates for a second. Many people think that farmland values have gone up only because the interest rates have collapsed. That's, in my view, not true. Interest rates do have an effect. There's borrowed money in the market for farmland, but interest rates do not have nearly the strength that I think some people give it in terms of land values. If you look at this chart for a second, you will see a couple of periods of time there when we all know that land values were going up while rates were going up. And you'll also see some times there when we know land values were stable or even a little bit declining and interest rates were going down. The correlation and the causation between interest rates and land values, it is a factor, but it is not by any means the most important factor. I want to then go sort of to the punchline of all this, and then we'll go to some questions. So if you look at what's happened, you've moved since, remember I said a few minutes ago, so grain prices are basically where they were in 2013. But yield per acre, and everybody's farm will be different, but on average, you've seen corn yields go up by 18 bushels to the acre in that period of time. If you take a $4.60 number, and I just kind of made that number up because it will be a function of, this is a cash price, not a board price. So think about what you might be getting for corn next fall. If you get 18 additional bushels, $4.60, you're going to put about $80 of additional revenue onto that acre. $80 of additional revenue at a 3.5% cap rate, so just dividing by 0.035, you're going to nominally create an additional almost $2,400 an acre of value in that piece of farmland if you just think about it as, I'm valuing this farmland as a function of profitability per acre. Remember that I would argue on a per bushel basis, our cost structure in the last 7 years has gone down, not up. You do the same math for beans, and it's not quite as compelling, but it's similar, and you're going to pick up an extra $1,400 an acre. So you average those two things. My perspective is that high-quality farmland, central Illinois, Iowa, this would also be true in southern Minnesota and eastern Nebraska and parts of Missouri and certainly parts of Indiana, that land should be at 2013 levels plus $1,500 or $2,000 more. This is why the lawyers wanted me to put up that chart that says, please don't sue us if we get this wrong. We own around 30 to 40,000 acres of that kind of land. And so I certainly hope we're correct. In fact, I believe we are. So with that, I've got about 5 minutes left. I'll stop it and open it up to questions if anyone has any. Thank you very much.
So I'm just curious, you have a very unique perspective to kind of look across not only the Corn Belt, but other states. Let's say Illinois is 12,000 acre, North Iowa maybe is 10,000, South Dakota is 6,000, Nebraska is, I don't know, 6, 7. Is there a discount, like to Illinois, that you think is a really good buy because it's going to catch up and accelerate more than the price of land in Illinois?
Yes, I frankly do. So this would be my perspective on that. The reason Illinois land is often priced a little bit higher than Iowa land, in my view, and Professor Bruce Sherrick is in one of the breakouts today, I'm sure he'll talk to this, is that because of the river transportation network in Illinois, the basis is a little narrower and a little more stable most of the time, and that's what I think drives Illinois land values. I think there's a secondary factor that there's an anti-corporate investing law in Iowa, which stops the flow of capital into Iowa land a little bit. But, remember, it's not just land quality, it's land, markets, weather, transportation corridors, all the rest go into that land value. But to the question of, I think you've seen some of the gain that we're going to see in Illinois and Iowa already occur. I don't track Iowa quite as well as Illinois, but we're seeing $14,000 sales in Illinois again. Now, I think 14,000 may be overshooting a little bit, but there's a solid amount of sales back in that 11, 12,000 range, and I think it's just going to continue to get stronger. I do not believe that impact has shown up yet in the High Plains, for example. We own quite a bit of land in eastern Colorado, and you have not seen these increases in price. Part of that is that eastern Colorado is in a terrible drought, and so, local weather factors will affect productivity and profitability per acre. I think you're going to see, though, the land values move. They've moved in Illinois, they've moved in Iowa. I think you'll see them move in eastern Nebraska next. You'll see them move in eastern South Dakota, for example. So I think you will see it nationwide. It's just showed up in the most sort of productive regions first.
Good morning. Say I sell farmland across the state of Iowa, Illinois, and most all of the land sales real estate brokerages have moved to online auctions for COVID reasons. With that, you talked a lot about the analytical drivers that drive farmland prices. What we see at auction is a lot of emotional drivers that drive the price of land up. With internet taking over, do you think that the emotion will still be there to raise or lower land prices?
As a buyer, I'm actually happy I don't get in that room anymore with your, guy that roams the room wearing the blue jacket and the tan pants and the cowboy boots. You all know the type, who's leaning on me to bid more. But I believe at the end of the day, all of these agriculture markets are fundamentally local. They are driven by farmers, but not just by farmers. I think an important factor in the ag market, in the ag land market, that people miss is people with rural roots, but who are not actually farmers, are a huge piece of that land buying market. Think of your local lawyer, your local doctor, the local dentist, the guy that owns the implement dealership. All of those people are fundamentally financially driven, but also locally driven, and they want to buy the land in their market. So I think you may take the top off just a little bit. Picture the two bidders, went to the same high school, dated the same girls, played on opposite one little high school against the other high school on a football team. These guys don't like each other. And they do get going at one of these auctions, and you sometimes get an extra 1,000 an acre in that. But I don't define the market, by the way, when you look at an auction, as the high price. I define the market is where there were still 2 or 3 bidders really going after it. Once you get to that last bidder or two, it's about emotion. Hope that helps.
Hey, Paul. As we talked about this briefly last night, but as the growing regions in the United States have changed, the USDA is shifting the growing regions based on growing degree days. What's that doing to land values in places like North Dakota, South Dakota, Montana? We don't talk a lot about that at this conference, but what's going on in Montana right now, and what do you see? And I'm Canadian, so I'm wondering how that's going to push north.
Yeah, so, I mean, I think we all know it. The corn belt, the corn soybean belt has shifted north and, frankly, west. If you think about, you didn't grow corn or soybeans in eastern Colorado, western Kansas, even 20 years ago. And that's gradually changed. I think part of that is global warming. I think more significantly, though, Robert, is seed technology. As it relates to Canada, Canada, it's almost trite to say, but Canada is a massive amount of land, a relatively low population, a pretty good climate. But I think it will gradually increase values of Canadian land, but not as much as you and your fellow farmers up there might hope. And it's fundamentally climate at the end of the day. The other thing that's going on when you look at, this is one of the unique, we only invest in the U.S., and one of the reasons, just as an aside, is the U.S. is a rare agriculture producer that is a dominant consumer market, huge country, big population, and a huge exporter. Almost every other country that we compete with is only one or the other of those things. China, huge producer of most of the key grains, no exports to speak of at all. Brazil, largely an export-driven market, not a local consumer demand market. And I think that having both parts of both the consumer, local consumer market and the export market makes our ag land values more stable. Thank you very much.